What's up, guys? It's Sam here, and I wanted to talk quickly about SPXL, which is the ETF I invested in, or I am currently invested in. Before I do that, make sure you press that subscribe button, or if you're on Facebook, you smash that like button so other people can see this shit or share it with them. Now, I feel that there needs to be some type of context because I don't think a lot of people have the same type of a lot of people don't have the same background as I do. So I started using Robinhood as a brokerage platform in mid 2018, I think it was, around June or July. And I didn't really I just bought some SPXL and that was about it. And I didn't really think about it. I was in the process of doing a lot of other things at the moment and I didn't have the desire to spend more time on it at that moment. And in investing, there's super basic, but you have alpha and beta. Beta represents kind of like the market as a whole. Alpha represents the abnormal above market return that's adjusted for the risk. So let me say that in a different way. If the market as a whole earns 10% and factored in for the risk, which would be in the financial markets is considered the standard deviation, is so if you had a Sharpe ratio of 0.5 or something like that, and you were able to say consistently generate a higher risk adjusted rate of return considering the other factors involved, that would be your alpha. Above the rate of return on a risk adjusted basis, that would be your alpha. In the financial markets, that is very difficult, nearly impossible for professionals to do if you look at the empirical evidence. I would definitely not recommend probably anybody watching this video to invest themselves not in SPXL, but just investing in general, unless that's the action required to get you in the mindset to actually take action to better your life. I wouldn't. I mean, more than likely, you're just going to lose money. So I wouldn't recommend it. But if that's the action required for you to take action on your own life to better your life in a way that is more fulfilling to you, then do you. And you know what I mean? Like, there's fucking zero judgment. Who the fuck am I to judge? But a beta on the theoretical level, it kind of represents the market in aggregate, right? So if you had something like VTSAX, which is Vanguard's, I think it's their total world index or something like that. It might be total stock market here in the US or something along those lines. And you could say that, you could look at the beta on that. And the beta would be 1. If you have a beta of less than 1, then that means there's less volatility relative to the market. And if we were in this example using VTSX as that's a ticker symbol for the Vanguard one, and I'm not associated with them or anything. It's just, by the way, I do have a link for Robinhood though in the description on Facebook. It's here, and on YouTube it's down there, and you get a free share of stock if you decide to open an account. It's also free to open an account and it's free to trade. So I've had a number of different brokerage accounts where it costs money to trade, and I like options. Anyways, so by the way, if you do that too, I also get a free share of stock. So it's something in the neighborhood of like $3 to $7 probably on average, but in terms of the share price. But there's also like Berkshire Hathaway and Apple you can get shares of. They just probably don't happen very often. Anyways, beta less than 1 represents risk less than the market, but also more than likely your return, if everything held up, would be less than the market as well. So beta greater than 1, then it would be converse to that, or the reverse of that. So in the way that I want to invest, right, I want a diversified portfolio, but I'm okay with going above 1 for my beta. And some of the easiest ways to do that is not you could do that yourself through borrowing money and then investing it kind of thing. And there's a lot more complicated ways of using different derivatives to add more beta. One of the easiest ways for 99% of anybody who wants to add more beta to their portfolio, which means just essentially increasing the return, because you're increasing the return, risk and return go hand in hand in the financial markets. So having a completely diversified portfolio, but then kind of leveraging it up, right? But then you also increase your risk. So that's the risk on the downside. If you have a very long time horizon, like I do, right? Then I'm okay with that. And that's what SPXL is. SPXL is a leveraged ETF. And what that means is they target using swaps and other derivatives. And that's, if you're interested in that, you should Google it or leave me a comment and I will make a video on those. Those are super interesting as well. But they use swaps and other types of derivatives to get 3x roughly what the market gets. So you have the market and then you use derivatives to try to represent what the returns would be times 3. So you're not going to get an exact proxy, right? But it's close, not exact, but you'll get the idea. And this is what I use in my own portfolio, not necessarily SPXL, right? Like that fund can change, right? Maybe it's too much volatility for you, so volatility just means price fluctuations, right, in the market. So if that's too much risk for you, then you could just do beta, right, like VTSAX, or you could do something that only has 2x what the market has, or there's even ETFs out there, or ETNs, which are like bonds. And you could have other ones that actually change in value in the opposite direction of the way the market goes. So it's inversely related to an index. But those are more for hedging most commonly. But it is an interesting concept, right? To use something along those lines, right? And so there's an act, I don't remember what it was. It was ERISA, which is the Employees Something Blah 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 Act, and that introduced a lot more regulations to mutual funds back in the day. And one of the ways you could kind of get around investing outside of your domestic country here in the United States is by creating a product with a large financial institution that imitated the return through the use of derivatives of some exposure that you wanted outside of a country. So let me dissect that real bit. I feel like that might have just gone over a bunch of people's heads. ERISA, right? This is this piece of legislation here in the United States. And through the use of different types of derivatives, you can have things that are similar, like an inverse ETF of some sort, where when one thing goes up, it goes down, or when this thing comes down, this goes up, right? Maybe you want to do that to protect against some type of interest rate risk, right? But if you were a certain, say, mutual fund, and you wanted to gain exposure to the index in Europe or in Asia or something like that, one of the Asian countries, you could contact Goldman Sachs, right? Not you or I can't do this, but maybe one day we could, but not today. They would contact the fund and go through creating some type of product that allows, say, the mutual fund to invest in something for a cost, obviously, that this product that was just created mimics the return of this index that's in Asia, we'll say, right? So that means if that Asian index goes up by 7%, the purpose of this product is to go up by 7%. So ERISA maybe tells this mutual fund that you can't invest in a certain way, right, outside of the domestic. And by the way, anybody who studies ERISA, or I'm not a lawyer, and I'm not trying to give any type of fucking financial advice or legal advice. This is just my understanding. And if you think I'm completely fucking off the wall and wrong, cool. You can let me know down below in the comments. But is a way to kind of get around certain legislation. Or if you have a business, there is ways you could potentially use something like that to hedge your risk, right? So if you're a financial institution and you have a bunch of loans, right? Like you're a bank and you loan money out. So you have, and maybe you do it through mortgages, right? Because that tends to be a large portion of a book of business for banks. Maybe you have all this fixed rate, interest rate risk, and you would like to add in some more volatility, or maybe you've done some other thing and you need a hedge from it. You can actually create a product that does the inverse of that to hedge that risk that you have on your balance sheet. Anyways, if you guys like this type of content or find this interesting, make sure to let me know. This kind of thing is I found interesting for quite a long time. So if you enjoy this kind of content, let me know by either pressing that like button or letting me know in the comments. Also, in the description on Facebook or on YouTube, you can find my link to Instagram. You can jump over there and ask me any questions. By no means am I stating or trying to give you financial advice. I'm just talking about my shit, and you are more than welcome to listen and watch along. Hope you guys have an amazing weekend. Talk to you soon.